Hi there, welcome in. We're just going to give it one more minute before we kick things off. Thanks everyone for joining us today. We appreciate it. Thanks for joining us for this Bright Tax session on maximizing tax benefits for U.S. expats. We'll talk about common questions that we see and the process of filing your U.S. taxes from abroad. My name is Allyson Lindsey. I'm a CPA here at Bright Tax. I have been in the global mobility tax space for about 10 or 12 years or so, and 8 of those years here at Bright Tax. And my role at Bright Tax is the Chief Talent Development Officer and Director of Finance. So I'm in a really special position where I get to work with our amazing team as well as serve our wonderful clients, just like you all. So, what are we going to talk about today? The tax filing essentials. So, what it looks like to file your taxes this year, maybe some catch-up procedures, and spend as much time as possible answering questions. I do think we will get through a lot of common questions in our about 15-minute presentation. So, if you want to hold off on submitting your questions to see if we answer them, feel free to do that. Otherwise, go ahead and submit questions through the Q&A, and our team will work on answering those, and I will answer as many as I can by the end of the session too. I've got my Gatorade ready. I'm ready to talk through a lot of those questions and answer a lot of them. And then finally, we'll talk through next steps. So what it looks like to file your U.S. taxes with Bright Tax and how we can support you. Alrighty, so on our tax filing essentials, who has to file a U.S. tax return? The answer is basically every American, every person who's a U.S. citizen or green card holder, whether or not you live in the U.S. or you live outside the U.S. You're probably here because you already know about our citizenship-based taxation. And there's some confusion occasionally that we see with people understanding if they need to file because they think they won't owe anything. And so here are the filing thresholds. So I won't read all of them, but if you meet one of these thresholds based on your filing status, then you would be required to file a U.S. tax return. Not that you'll necessarily owe U.S. taxes. A lot of our clients don't owe because of the different claims that are available to wipe out the U.S. tax liability, but they do still need to file. And there is an important filing status that I want to call out here, which is married filing separately. That says $5. So no, that is not a typo. We didn't forget some zeros on there. That is truly the threshold. If you file separately from your spouse and your worldwide income is more than just $5, then you are required to file a U.S. tax return, even if your worldwide income is below that $14,000 for singles. Excuse me. And that is a really common scenario for our expat clients because a lot of people move abroad for love and they're married to non-US citizens or green card holders, non-resident aliens, as we call them in the tax world. So in those cases, you would use the status married filing separately so that your spouse doesn't have to report their income on the US return, but it does have a much lower filing threshold when you have to file. Another specific threshold to call out is for self-employed individuals. That is also a lot lower than the other thresholds that you saw on the screen before. That is just $400. So if you earn $400 in gross self-employment income during the year, you have to file a return. Again, you might not owe anything, but you still have to file the return to make that claim. Similarly, to make the claim of any expenses that would reduce the net self-employment income. So for example, if you had $500 of self-employment income, but $600 of expenses related to that business activity, your net would still be a net loss of $100. But in order to claim that you have a net loss, you have to file a tax return to report that. And this is self-employment income coming from anywhere in the world, from U.S. entities reported on a 1099, freelance activity, inside the US, outside the US, whether or not it's reported on a 1099, it would still trigger this filing requirement for self-employed individuals. Another common filing requirement is the FBAR and FATCA. These are similar forms, and they're purely informational disclosures to report your foreign financial accounts. FBAR stands for Foreign Bank Account Report, FBAR, FBAR for short, and that is required if the sum total of your non-US financial accounts exceeded $10,000 at any point during the year. So in this case, we're looking at the aggregate of all of the high water marks. And I always think this is a little bit of a misnomer because it's called Foreign Bank Account Report, but it's actually not just bank accounts. It's your, of course, bank accounts, checking and savings, but also pensions, retirement, investments, anything that has an account number on it and your name on it would need to be reported on the FBAR. It also includes signatory accounts and accounts that you hold jointly. So if you're a signatory on, say, your parents' account abroad, that would trigger the FBAR requirement if in aggregate your accounts exceeded $10,000. It also includes the maximum balance of the account, whether or not you own the account 100% or you share it with somebody. So in the example before, if you move abroad for love and you have joint accounts with your spouse, you wouldn't report your 50% share. You would report the 100% maximum balance. Again, it doesn't drive any tax liability. Basically, the US is nosy and wants to know where your money is when it's outside the US. And then when it comes to the high water marks, all of your accounts would need to be reported. So for example, if one account hit $4,000, another account hit $8,000 in aggregate, you'd have a $12,000 maximum balance. So that would trigger reporting for all of your non-US financial accounts. So the FATCA is similar to the FBAR in that it doesn't drive any tax liability. It's purely informational. Form 8938 is a statement of foreign financial assets, and that's what we call FATCA because that's the rules that it related to when they came out several years ago. Like I said, it's similar to the FBAR in that it doesn't drive any taxes, but the thresholds are different and where it gets filed are different. So you'll see thresholds starting at $50,000 or $200,000, depending, and they depend on if you're inside the US, outside the US, and then your filing status. So if you file jointly, separately, head of household. It also looks at maximum balance during the year as well as December 31st balances. So I would recommend working with an accountant to make sure that you have those bases covered. Both of these have hefty penalties associated with them. So if you were supposed to file them and the IRS finds out that you didn't, you could get assessed some pretty big penalties. The other difference between the FBAR and Form 8938 are where they get filed. So the FBAR is filed actually separate from your tax return. It gets filed with the Financial Crimes Enforcement Network, FinCEN for short, whereas Form 8938 gets filed as an attachment to the tax return itself. So they're similar but different, and definitely things to keep an eye on if you need to file them. When in doubt, if you're unsure if an account should be included on either of those, we recommend including it. Better safe than sorry, which is a very CPA thing to say. So when do you have to file all of these? We are now in April, and March just flew by for some of us. And so we're thinking about filing taxes because April 15th is the standard deadline for most Americans. If you're in the US, that is the deadline to file your return. If you're outside the US, you do have an automatic 2-month extension in place to file the tax return. And that's automatic in that you don't have to submit anything to request that extension. You just need to include a statement with the tax return, which is something that we would help you with when we file the returns. But I will note that extends the time to file the return, but not necessarily to pay if there's a balance due. Technically, if you have a balance due, that would still be payable by April 15th, and then could start accruing interest after that date if you have that extension in place. So the extension allows you to avoid a non-filing penalty. Technically, the FBAR is due on April 15th, except that one also has an automatic extension until October 15th. No action needed to request that extension. It's just built in. And then also on October 15th is the extended deadline from April 15th. So for example, for a lot of clients coming in the door for us right now, we tend to submit extensions all the way to October 15th. Again, because we're accountants and we're conservative, so we like to have plenty of breathing room, just in case that's needed. And speaking of breathing room, sometimes even more time is needed, and there's another extension available until December 15th. Normally, the IRS will shut down their e-filing system around late November, so you would have to mail in the return if it's on December 15th. But there are circumstances where you just need to wait for time to pass, or you're waiting for your foreign tax return to be completed, which is why there's all these extensions available for abroad taxpayers. And if any of this is news to you, if this is a surprise and this is your first time hearing about citizenship-based taxation, the FBAR, scary penalties that I alluded to, you're not alone. There's a lot of clients who come to us and just had no idea they were required to file a U.S. tax return. And that could be from they just didn't have the information. When you cross the border, they don't necessarily give you a pamphlet that says, hey, go to BrightTax and file a US return. Don't forget. Or a lot of people misunderstand that the treaties in place between the US and a handful of other countries think that you don't have to file in the US. Or if you're under a certain threshold, some folks think that they don't have to file. There's also people who don't even know that they're US citizens, and then they find that out. Those are the accidental Americans that say, oh my gosh, I just learned that I'm a US citizen. I need to file my US tax return. And in those cases, we can certainly help. There are some programs available to help you get caught up penalty-free for the most part. And the most common one that we do is the streamline procedure. That allows you to get caught up on all of your missed tax returns by filing the last 3 years of delinquent tax returns and last 6 years of foreign bank account reports, those FBARs, and you get caught up penalty free. So if you did have a balance due, which most of our clients don't, it would be accruing interest, but no penalties. And so the benefits there are penalty free, and you only have to file 3 years of returns rather than say 40. We have some clients who've never filed, or it's been 40 years since they lived in the States. And I always think about it'd be impossible for me to find my my tax documents going back even 10 years, let alone more than that. So 3 years make it a little bit more manageable. There are other amnesty programs available, kind of depending on your situation and what was missed. And so if when in doubt, feel free to reach out to BrightTax, and we'd be happy to help you figure out the best program for you to get caught up. For the streamlined procedures to qualify for that, it has to be non-willful. So you'll submit a statement that says, I didn't know I was required to file. Here's the reason, and I'm signing it and certifying that. The other requirement to qualify for the offshore streamlined procedure is that you have to have at least 330 days outside the US during one of the years that you're qualifying for. If you're not outside the US for that period of time, that's not the end of the world. There's another domestic streamlined procedure that's available for you. So I've mentioned a few times that a lot of our clients don't owe US taxes. And the reason why is because we claim the foreign tax credit or the foreign earned income exclusion to help offset the US tax liability. And the foreign tax credit, and that's reported on Form 1116, is a dollar for dollar offset for taxes paid to a foreign country that we can use to wipe out the US tax liability driven by foreign source income. So if you had all foreign source wages, then and you paid foreign taxes on that, then typically we're able to use that to wipe out the entire liability. The other option is called the Foreign Earned Income Exclusion. That allows you to exclude up to about $120,000 annually right off the top of taxable income. So in that case, you report your gross wages and then subtract them out under the Foreign Earned Income Exclusion. And if that's your only source of income, then there might not be any tax liability. That amount does change a little bit each year for inflation. So each circumstance is unique, and we get a lot of questions on which one should I use. When we prepare the return, we take in the information for both options. So we say which is going to give us the most beneficial option, what's available based on what you filed last year for continuity's sake, carryovers that we might want to take advantage of. But for a little bit more details, it really depends on the situation, the sources of income, and the amounts. So the foreign tax credit only works if you've paid foreign taxes or if you've accrued foreign taxes. And that can only be applied against foreign source income. So in some cases, you might have foreign source income and US source income. Even if you've paid a lot more in foreign taxes, you wouldn't be able to wipe out the US tax liability driven by US source income in most cases. The other piece on the foreign earned income exclusion, there are two methods that you can use to qualify for this. One is called the physical presence test, which requires you to have at least 330 days outside the US during any 12-month period. So ideally that's January to December, and then you get the full amount of the exclusion. However, sometimes that's not available, like if you moved abroad in that year. So it might be April 1st of 1 year through March 31st of the next year for that 12-month period. As long as you have 330 days outside the US, then you can claim a prorated amount of the exclusion. The other test to qualify, if that one doesn't work, is the bona fide residence test, which essentially requires you to be a resident of the foreign country from January 1st through December 31st. It's a lot more facts and circumstance based, so it's not quite as black and white as we accountants like with the physical presence test. But we have a lot of clients who use this test because it allows for more flexibility into the US. You're not trapped with those 35 days. That said, we still don't recommend spending like 6 months in the US and trying to claim that you're a resident abroad. But it evaluates more subjective qualifiers like who you live abroad with, what type of home that you live in. Is it leased? Is it a tourist visa? There's a whole bunch of different qualifiers that we would answer on the tax return. And then my final qualifier on the foreign earned income exclusion is that this only applies to earned income. And that's in the name, but is a very common misconception. So earned income means like wages, salaries, self-employment income. It does not include retirement income, Social Security, investments, passive income. So even though I kind of consider retirement income well earned, the IRS does not. And so that would not qualify under the foreign earned income exclusion. In that case, we would look to see if we can use the foreign tax credit to wipe out double taxation. So just a summary of how we reduce your US tax bill, avoid those penalties. There are some scary penalties that the IRS has out there. We don't need to provide any scare tactics. The IRS does a good enough job. So clients often come to us if they haven't filed before, a little bit stressed out, and we get to help them get caught up, and most cases penalty free because of these amnesty programs. But keep an eye on this, of course. That's why you're here, to learn how to stay in compliance, file on time, pay by April 15th if you owe. A plug for a couple of other disclosures on the international side that we see a lot here at Bright Tax. The foreign corporation disclosure is required in most cases if you have any type of foreign registered entity with limited liability, even if it's a single member limited liability company. It gets different treatment if it's outside the US compared to what a US LLC would be treated as. A foreign partnership also requires a disclosure, as well as foreign trusts, which you see these forms listed on the screen. And one final plug for the FBAR and FATCA for the Statement of Foreign Financial Assets, just because we see those so much. and we want to make sure that everybody is aware of them. Alrighty, so that is the conclusion of what we have prepared for the presentation. And so now I will go through the questions that we have and get as many questions answered as we can. And let me pull that up. Alrighty. So this question says, I live in France but maintain a US address. And I have always filed as a US resident since I didn't earn income outside the US. However, I became a resident at the end of 2024 and the income situation hasn't changed. Is it a better idea to file my 2024 taxes from abroad since I plan to permanently live in France and also impacts the US tax filing deadline as well? If so, does that eliminate the need to file an extension for the April 15th deadline? All right, I'm just sorting through this one. So they file. So typically we recommend to file the foreign tax return first and see what they're going to tax. Most likely, since this person became a resident in France in 2024, they'll probably want to tax a good chunk of their income, maybe their worldwide income. So we would look to what is taxed in France. We would look at the treaty based on which treaty gets first taxing rights on that income, and then claim the foreign tax credit on any of the income that is considered foreign source that taxes were paid on in France. Um, the other part of this question is about the deadline and needing to file an extension for the April 15th deadline. I typically still recommend filing that extension to give yourself enough time to get the foreign tax return filed, to find a CPA, to prepare the return, and have enough time to answer any questions. If you expect to owe, or if you've owed in the past, sometimes it's tricky in these years that you have a split situation. But I would recommend making a payment for what you owed in the past at the very least, if you don't have a good estimate otherwise. So I do recommend making a payment if you owed in the past and still submitting the extension. You do have the extension until June 15th, so you don't have to do anything to actively request that. All right. This next question is, my wife and I have a joint Portuguese bank account that has had balances above the FBAR threshold. Do we need to make separate FBAR filings or a single FBAR? That's a good question. If that is the only account, you can file a joint FBAR filing. If you have accounts that that you own separately and you have a joint one, you would need to file two separate FBARs to report your own individually owned accounts, as well as basically reporting that joint account twice, one on your FBAR and then one on your spouse's. But if that's the only FBAR, if that's the only foreign account, then you would only have to do that once. All right. The next question is, can you explain the foreign tax credit and how tax offsets work? I think we talked a little bit about that, but as a summary is the foreign tax credits are a dollar for dollar offset for taxes paid to a foreign country that can be used to wipe out the US tax liability on US taxes driven by foreign source income. And this other question is, what's the cost of expat tax filing for a married couple? Here at Bright Tax, how our process works is we will typically take in your information either via email or via a phone call and get to know your situation so that we can put together a firm quote. And that is actually perfect timing to talk about our next steps and how our process works. So I appreciate that question. The question was asking what's the cost, but I'm going to use this to take a second to let you know how our process works. Like I said, we would take in your information, put together a firm quote based on your complete scenario. Our prices start at $540. But we would put that together based on everything that's going on. Then we will send you the quote. If the quote's approved, we request about a 30% retainer to get started, then kick off collecting your information on our client organizer. We'll send you a list of everything needed to prepare the return, and that's based on that initial conversation via email and via phone call. Then we prepare the returns. It goes through multiple levels of review with our tax team, and then we would send it back to you via the organizer. Once the return is approved, we would have you sign e-file authorization forms and get everything e-filed for you, both the return and the FBAR. Oh, this question I think might be related to another one asking about a WISE account to transfer money from the US to the Portuguese account. And is that considered a foreign bank account? The answer is it depends based on where you registered the WISE account originally, because there are WISE accounts that are registered in the US. And if so, you do not have to report that on the FBAR. And then other accounts WISE accounts that are registered outside the US, and you would have to report that on the FBAR. So you can actually go into your WISE account and find basically the address of it, the physical address of if it that they have to register it with, even though it's an online bank, and determine where it is. If you're unsure with any bank account, I recommend reporting it. On the FBAR, you do have to report the bank name, address, account number, and the maximum balance. So either way, you'd have to find the bank's address and include that on the FBAR. This question is the minimum income threshold to file gross income or taxable income? That is gross income. So that is a really good question. We arrive at taxable income after we report gross income, subtract out the standard deduction and any other offsets, and then arrive at taxable income. This is a Canada question. For a resident of Canada, when they will receive retirement income from the US, such as a pension or IRA distributions, does the Canada Treaty allow all that income to be effectively sourced to Canada? So one pays all of their taxes to Canada and claims a foreign tax credit on the US return. I will start by saying I am not a Canada expert, just US for everyone here at Bright Tax. However, the treaty between US and Canada is the most helpful treaty out there, in my humble opinion. Typically, the treaty allows for sourcing for Canada to have first taxing rights. It depends on the type of distribution from the retirement account, but typically Canada does get first taxing rights. So you report it, pay taxes to Canada, and then on the US side, you would report that income as well, and then claim those foreign tax credits. Again, please talk to a Canada expert to confirm the Canada side, but that's what we tend to see in practice. And we have a lot of clients in Canada, so I get to see a lot of Canadian tax returns as the finished product. Alrighty, this question says, I didn't make any income last year as I moved to France and didn't work, but I did receive an RMD. That's the required minimum distribution from an inherited IRA that exceeded the 14,600 threshold. So the filing threshold for single people, I believe. So do I still need to file an income tax return with the IRS and or France? Definitely the IRS, you do still need to file a return because you exceed that threshold. For France, I would recommend confirming with a French tax specialist. We do have some referrals for those. If you would like to reach out, we can share those with you too. Question says, if I earn income in multiple countries, how do I make sure I am not paying twice on the same income? Good question. And it can be a little bit circular if it's multiple countries. It can be circular if it's just two countries. Typically, you would need to look at who gets first taxing rights on the sources of income and file that country first to make sure that you're reporting those taxes. Then in the other countries, you would still report it if required. So in the US, you would still have to report it and claim foreign tax credits. In some cases, like in Canada, a lot of cases, we have to do a draft of the US return after the draft of the Canadian return is done so that they can use some of that information to inform the Canadian final return. Then we can finalize the US return. So we go around a couple of times, but you just want to make sure that it's clearly laid out who's getting first taxing rights, making sure that it's reported as foreign source as appropriate, and then wiping that out with foreign tax credits to avoid double taxation. All right, a question on love. Those are my favorite ones. If I marry someone who is not a US citizen, how does that affect my tax situation? You'll most likely use the filing status, married filing separately. If you have dependent children who have US Social Security numbers, if they're also US citizens or green card holders, then you might be able to use the filing status head of household, which is slightly more favorable. Your non-US citizen spouse, the non-resident alien, as we call them, does not necessarily have to file a return unless you make the election to file jointly with them. Most of our clients prefer not to because they don't want to have to go through the paperwork and they don't want to have to report the foreign spouse's information to the US. There are some cases where it makes sense to do that, in which case you can make a 6013G election to get all tax technical on that. The other piece you want to look out for filing with a non-US citizen spouse is just making sure that you're capturing all of your accounts that you have signatory authority over or that you own jointly for the FBAR and FATCA disclosures. That is a pretty common scenario where we have clients say, oh, I didn't realize my spouse put me on this account, so now I have to go back and amend. So it's just keeping an eye on things in that case. What happens if I get audited while living in another country? Contrary to popular belief, I think, and maybe movies, the IRS does not knock on your door if you get an audit. They actually don't even call them audits, they call them examinations. So if you were to get audited or get an examination, the IRS would send you a letter. And actually, whenever the IRS communicates you, they only send letters. They're very old school that way. They also only accept faxes. They don't send emails. Those are really common phishing tools that we've seen scammers try to do if they're pretending to be the IRS. So coming off by tangent, if you get audited while living in another country, you would get a letter saying you have an examination. Please provide these details by X date. This is what we need as proof. An example of that might be if you claimed the bona fide residence test under the Foreign Earned Income Exclusion. The IRS might want additional details to say, okay, we got the information that you self-reported. Can you provide proof of your residency abroad, your type of visa that you live on abroad, a copy of your lease, what supports it? Because on the tax return itself, it only requires a self-reporting to say this is the information, but you don't have to attach any of that with the actual tax return. That said, in practice, we very, very rarely see those types of audits, but I think it's a good question and one that we get a lot too. This question is, what is the FATCA threshold for reporting? Is it the same as the FBAR with a different threshold? So coming back to that, the FATCA threshold varies based on where you're located, inside or outside the US, as well as your filing status. So if you're single living in the US, the threshold starts as low as $50,000. If you're married living outside the US, it starts at $200,000. And it depends on your maximum balance of your accounts at any point during the year, as well as your December 31st balance. So that's why we didn't go into those in detail. It's not quite as cut and dry as the $10,000 threshold for the FBAR. But the IRS actually does have some really helpful guidance on that. That's easy to read. Or else feel free to reach out to Bright Tax and we'll help you get that sorted. All right. Oh, another question on FATCA. I mentioned the high water mark during the year as well as the end of the year. Um, what we do is look at, they said, isn't it just high water using end of year currency value? In practice, it kind of. So in practice, we do use the end of the year currency value just for sake of consistency across the tax return. But the FATCA threshold says, did you exceed, for example, the one living in the US, did you exceed $50,000 on December 31st or $75,000 at any point during the year? So that's why you might not have exceeded one, but you did exceed the other, and that would trigger the FATCA reporting threshold. This person is moving to Portugal, which is a great place to move, and we see a lot of clients moving there. They ask, do you provide tax support for tax filing in Portugal and reconciliation with the US tax reporting, such as the exceptions provided through the tax treaty? We would be able to support on the US side of things, and we do have a referral in our Bright Tax Global Referral Network that we would refer you to for the Portugal side of things. And we work pretty closely together. It's not under one umbrella, but it's more of a referral relationship. And typically that involves the Portuguese tax return getting done first. We use the information, everything that's reported on there and taxed on there to claim foreign tax credits and other exclusions on the US return. We do look at the treaty as well, but that's surprisingly maybe not quite as commonly needed as you might expect. All right, this question is confirming on FBAR versus 8938. A married couple needs an FBAR per person, even for a joint account, but the 8938 just needs one for the joint filing. Correct. So the FBAR might have two separate filing requirements if you have separate accounts as well. The 8938, since that's attached to a joint tax return, if you file jointly, would be just a single 8938 attached to the tax return itself. And in that, you're checking boxes of who owns a joint, spouse, or taxpayer. Does the foreign tax credit and the foreign earned income exclusion, do they both apply to green card holders too? Yes. So green card holders have basically the exact same treatment from the tax perspective as US citizens. So that comes with the good and the bad, I suppose. The good being that you can take advantage of all of these exclusions. Everything that I talked about today applies to both US citizens and green card holders. Yeah. Just thinking about which tangent I wanted to go on, but I will continue with questions. This question says, I've been reporting foreign bank accounts via the FBAR for years, but didn't know about pensions also needing to be reported now. Apart from including my pensions in this year's FBAR, do you have any other recommendations on what I should do now? So we talked about the streamline procedure, and that might not be necessary in this case. The streamline procedure would file the last 3 years of missed tax returns if needed, as well as the FBARs. In this case, I would recommend a procedure called the delinquent FBAR submission procedure, which requires you to file the last 6 years of amended FBARs and to indicate why those are late so that you can avoid the scary FBAR penalties on that. And in this case, they wouldn't even be late to indicate why they were amended. And there's on the face of the FBAR itself, there's actually a whole list of reasons why it's filing late. And then we would refer to the delinquent FBAR submission procedures. That's a separate option that you would include. So that says to me, this happens all the time. And what we've seen in practice is this happens all the time. There's just a lack of information, of understanding, of thinking you got it right. And then it's just one missed thing. So the delinquent FBAR submission procedures would be the best case in that situation. So you don't have to go back more than 6 years and you get caught up penalty free under that method. We do a lot of those as well. Can you switch between foreign tax credits and foreign earned income exclusion from year to year, depending which is more beneficial each year? Not quite. So if you claim the foreign earned income exclusion, and then in the following year, if you were eligible to claim it and you don't, that means you've revoked the exclusion for 5 years. And so sometimes that makes sense depending on where you're moving and sources of income, as well as projected sources of income. But you can't flip flop back and forth. When given the option, we usually start with the foreign tax credit. So that we're generating foreign tax credit carryovers. Those can be carried over up to 10 years. And then if you need to switch over to the foreign earned income exclusion, you can, but it's just switching out of that. That gets a little bit stickier. For a foreign tax credit, if there's a double tax treaty, thinking of Portugal, which taxes worldwide income, then US source can be part of the foreign tax credit. Yes, and it depends. So that's exactly what we would use the treaty for, is to see between the treaty of the two countries, which country has first taxing rights. And so a lot of the time it'll be your country of residence, Portugal in this example. If the treaty is saying they get first taxing rights, then we would, it's called treaty resourcing on the US side to say, normally this would be US source income, but because the treaty says we can source it to Portugal, then we can claim it as foreign on the US return. In that case, there's a special Form 1116 to file for the foreign tax credit calculation, as well as Form 8833, which is the treaty return position disclosure to claim, to show why you're eligible to make that claim as the treaty position. Just to confirm on the foreign tax credit, if living in a foreign country and you collect Social Security, 401k, etc., I would not get credit for taxes paid in Portugal. So I think we answered that above on you might get credit for taxes paid in Portugal if we can claim it under the treaty, which I expect to, but of course, with my disclaimer of we would research the treaty. Unfortunately, I don't know all of them off the top of my head yet. One day I'll be a super treaty computer. Do you guys prepare taxes in any other countries like Portugal? Portugal's a popular place. If not, any recommendations like PwC? PwC does great work. The Big Four does. A lot of us came from Big Four, and that's where we got experience. I came from Deloitte. Also coming from Deloitte, I know how much they charge, and it's a lot of money to prepare just like a regular person's tax return. So we do have referrals for a lot of countries, as well as like a database that we can refer to if the country that you're looking for does not have a specific referral within our Bright Tax kind of extra vetted referral system. But here at Bright Tax, we just focus on US taxes, and we do support Canadian taxes. I'm not the Canadian support person, if that wasn't clear, but we do have a team member who can prepare Canadian taxes as well. Does an individual qualify for any foreign tax credits trading stock, equities, and options if they are an expat using a US brokerage? The one thing they might qualify for is foreign tax credits if you're paying taxes abroad. So there's how you avoid double taxation. For investment income, there's different rules on the sourcing of the income. For example, dividend income, actually, capital gain income on sale of shares is sourced based on where you're physically located when you sell the shares. So if you're in the UK, the UK would probably get to tax that, and we would claim foreign tax credits on the US side. If you're not paying foreign tax credit, if you're not paying foreign taxes on it, then probably will look similar to how you would as if you were still living in the US. Alrighty. I got another question on UK tax requirements. We do have a specific referral for somebody in the UK as well. This person says, I will live in London, UK. I live in London, UK. Which form do I use to file for tax relief based on my two US-based pensions? So that depends on what the UK is taxing, and it would be a combination probably of the foreign tax credit, Form 1116, and the potentially Form 8833, which is the treaty-based return position disclosure. Pensions, as a reminder, do not fall under the Foreign Earned Income Exclusion, so you would not use Form 2555. Do you provide French tax filings for US citizen living in France? Unfortunately, no, not France, but we do have a specific referral for France. So feel free to reach out to us, or our team can send you a note with that referral who's in our Bright Tax Global Referral Network. Can retirees living abroad get a foreign tax credit? Yes, if they are paying taxes to the foreign country, then most likely they can. Can I get tax relief on social security retirement? I think is what this is saying. In the UK, that is specifically called out in the treaty that the UK gets first taxing rights on social security. So I'm mentioning that first because that popped into my mind first, that the UK would get that, and then we'd wipe out the US tax with that. Other countries, it does depend on the treaty. Typically, it would still, well, no matter what, it would still need to be reported on the US return, but it's a matter of how we avoid double taxation. So if you're getting taxed abroad on it, we want to make sure that we're claiming treaty resourcing if needed, as well as any foreign tax credits to avoid that double taxation. Does the IRS actually pursue people who do not owe any tax? Say I earned under 25,000 living in France and I don't file in the US. In practice, I have not seen it. My thought is kind of what's the point for the IRS to pursue that unless they have another reason to do so. That said, I'm a CPA and inherently risk averse and fairly conservative with my advice. So I still recommend getting your taxes filed, also with the intent of one day the IRS is going to get more sophisticated and maybe be able to actually send emails and not just faxes and letters, and be able to see what citizens are doing and card holders are doing worldwide. So at that point, do you really want to be scrambling to get caught up then? The other thing is with the streamlined procedures specifically, the IRS can pull that at any point. It's been in existence for many years, but they don't have to leave it in existence. So it could go away tomorrow if they so choose. I don't expect that to be the case, but that's kind of my risk aversion CPA coming through. I haven't filed in several years due to low income and financial hardship, but plan to catch up this year. Can I still use the streamlined foreign offshore program? If you meet the other requirements, the non-willfulness and time outside the US, I would guess so. Obviously, we would want to talk through your scenario and make sure that you do qualify for it. But I think this sounds like a really good option to get you caught up penalty free and just file the last 3 years of return under the streamlined procedure. This person says, I'm a US citizen. I will be starting a new remote job in May and plan to live in Thailand. Would I still qualify for the physical presence test if I have a long-term lease? Should I only remain in Thailand for less than 180 days and have my employer pay me as a US resident to minimize my foreign tax exposure? So the question on minimizing foreign tax exposure would definitely be more of a Thai question. So I'd recommend working with an expert in Thai taxes. But to clarify in the physical presence test question, that physical presence test relates if is we look at that if you have at least 330 days outside the US during any 12-month period. So we could look at May 2025 through May 2026 and say, did you spend at least 330 days outside the US during that period? If so, then we can claim a prorated amount of that exclusion for those 8 or 9 months or so out of the 12 that you were outside the US during the calendar year. The other question relates to the long-term lease. That is probably more related to the bona fide residence test that asks, are you a permanent resident from January 1st through December 31st? So for 2025, you would not be because you start in May. For 2026, you might be, depending on what your status is abroad, if you have to pay taxes there, what type of lease you have. But definitely on the Thai questions, speak with a Thai advisor. Next question. If I work with you for streamlined filing service, how would I know what documents or information you need? So in that case, we would provide you with a list of everything needed to prepare your returns after we have this conversation with you, to get to know your situation a little bit more. In most cases, that's copies of your foreign tax returns or wage statements, as well as the foreign account details. So you don't even need to provide us with bank statements. In fact, we typically ask kindly that you don't upload 6 years of bank statements to our system. But we do trust that what you provide is accurate. So the numbers that you're putting into our system, we'll use that to inform your tax returns and FBARs. Of course, we'll pull the numbers directly from the foreign tax returns. And let's see. And then we'll also ask for more information on reason for late filing and those details. Oh, I know, I was gonna say, we recommend that you keep those bank statements in your own records, just in case the IRS would ever ask for them, which I've never seen happen, but I'm an accountant, so I advise people to keep their records. Alrighty, how can I learn about tax liability in Vietnam if my only income will be from retirement and pension? No foreign income, is there a tax liability in Vietnam? Good question for Vietnam tax advisor. So I definitely recommend chatting with somebody. I am a green card holder, but recently got a job opportunity in Singapore. What tax implications will I have with the US? If I move in the middle of the year, do I claim the foreign tax credit for the first year and then the exclusion thereafter? It depends on a lot of different factors. The amount of taxes that you pay in Singapore, if you qualify for the foreign earned income exclusion at a prorated amount. So we talked about that 12-month period can be shifted depending on where you're located, or excuse me, depending on when you move. And when we prepare the return, we take in information for both options. So we would say which would give you a better position based on everything coming together. And that could be income that you earned before you moved or while you were there, and to say which puts you in the best position when we put all of the pieces together. And we always compare those when we prepare tax returns here at Bright Tax. Oh, this is a good one. Do social charges in France represent foreign tax paid as an offset? This is new in the tax world, as in like a few years old. And the answer is yes. So they used to not be considered, social charges are typically not considered available for foreign tax credits because it's only income tax that's available for foreign tax credits. However, a ruling came out a couple of years ago, forced France specifically saying the French social charges, which I can't remember what the abbreviation is now, can be claimed as foreign tax credits, similar to foreign income tax for foreign tax credit purposes. Question on state taxes. Do former New Jersey residents have to pay state tax? The answer is it depends. What a surprise. That's what my tax professors used to say in tax. It depends. So it depends on your source of income and the domicile that you have with the state. In many cases, just kind of to generalize, states are a lot more logical than the feds in that they typically file residency-based taxation. So if you move out of the state, intend to stay out of the state, don't spend too much time back in the state, then you might no longer have a state filing requirement. You might file one final part year state tax return to say, I was a part year resident from January to March, then moved out of the country and then became a non-resident. So that's the part year state return. Thereafter, in year 2, you might not have any state tax filing requirement. If you don't have any source income there, so you don't have to file any state tax returns. So a lot of our clients are only filing federal returns at this point because they don't have ties to any state. So there are exceptions to that. We have to look at each state has different rules on what it takes to break state tax residency. Another common example is if you have state source income. So let's say you're considered a non-resident because you don't live there and the rest of your ties have been broken, but you have a rental property in the state. So you would still file a state non-resident tax return to report that only that state source income, and you don't have to report worldwide income. Each state is different on the rules for what it takes to break state tax residency. And I don't know the rules for New Jersey off the top of my head. So that would be a worthwhile consultation to dive into. What is the definition of foreign source? In the Canada example, I saw CA, so I was thinking California. In the Canada example, a US RMD was foreign source to Canada, or did I misunderstand? So in that case, the sourcing is based on the rules for the specific type of income as well as the treaty. So an example of that is wages. Wages are sourced based on the IRS rules where you're physically located when you're performing the work. So if you're in Canada performing the work, that's foreign source income. A US RMD, typically a US pension distribution is what that's referring to, or retirement distribution, is typically default to US source unless there's another reason why it's not. So we have to look at where it's paid from and the location of the taxpayer. Capital gains are another example of location of the taxpayer drives the sourcing. So another answer of it depends, and worthwhile to research that and work with a CPA. All righty. I'm going to answer, I think we have time for about one more question, and then we will wrap up. And I'm going to end with this kind of easy one. We have a ton of questions still, so we will get back to everybody. And feel free to reach out to us. You see the QR code on here to schedule a professional consultation with our team. We obviously love talking about US taxes, and things that we don't know, we'll let you know. Things that we do know, we'll give you all of the information that we have. And this final question asks, are standard deductions different for US expats, or is it the same as everyone? I think that's a good question. They are the same for everybody. The thing that might be different or might feel different is the foreign earned income exclusion. It's not the same as the standard deduction, but I think that's where confusion happens because the standard deduction everybody gets if you file a 1040, and depending on what your filing status is to reduce your taxable income. Another reduction to taxable income or above taxable income, it's called above the line, is the foreign earned income exclusion. So they are similar in how they function, but the true definition of a standard deduction is that US expats and individuals get that if they file a 1040 and are humans. Alrighty, so we did not get through everything. I do need some Gatorade to refuel, but I appreciate everybody's questions. Our team will get back to you and provide you as much information as possible. And we do have another webinar similar to this one next Wednesday. So our final one, and that will be run by Caitlin Minot, who is our Bright Tax CEO. So thank you everyone for joining us. We appreciate your questions and appreciate your time. Have a great day.